Good morning and welcome to this Monday, February 27th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got a new week getting ready to kick in, end of February, right around the corner. That'll be tomorrow. And then we head into the month of March. Going to be an interesting March for sure, with most of our major most of our major indices below their key moving averages. We've seen that now on the Dow, the S&P, the NASDAQ, and so forth, where we've gone back down, moved beneath the 20 days. I actually think it's just a period of consolidation. Some might think this is a downtrend. I don't know. We've got futures up again, so we'll see. I shouldn't say again, but we got them up. So we might move back up above that 20-day moving average today. We'll see. But currently, we do have futures up 240 points on the Dow, 35 on the S&P, 137 on the NASDAQ. So we're up more than 1% on the NASDAQ. We've got the 10-year Treasury yield down 4 basis points today, back to 3.91%. 3.9 was that key level that we were fighting on the way up. We went through it, held above it for a few days. Now we're back down testing it right now. Crude oil prices down 34 cents, just below $76 a barrel. So we do have yields coming down, oil prices coming down, futures are up. So at least to start the week, looks like we'll get off to a pretty decent start. Last week was the worst week we've seen so far this year. Not too surprising after the move we made heading into the in 2023 ahead of that week last week. We'd had pretty nice movement to the upside. We had a lot of in-the-money call premium. So last week was the week after options expired. That tends to be a pretty poor week for equities historically, and that was the case again last week. So I think we're kind of starting fresh a little bit here. We'll see if we can get back up through the 20-day moving average. I do like the market a little bit more now here that we've pulled back. I think we've got a little bit of downside potentially. That's just my opinion. Long term, though, I see a lot more upside. So I like the reward to risk here with this pullback. I know when we were talking about options expiration with our members, talked about maybe 290, that level on the NASDAQ, the QQQ, 290. Well, we got right down to it, literally almost to 290 at the end of last week before rallying at the end of the day, and now we see futures up. So that could be it. I'm hopeful, but I also realized a lot of things can happen in the market short term. Let's go ahead and let me get things going here. First of all, I want to welcome everybody. Again, it's the start of a week, almost ready to head into March. For members, I do want to remind you, I will be heading on vacation at the end of this week. I'll be out of the country for a week. So a lot of things at Earnings Beats will come to a halt. We'll still be open. We still got customer service. If you want if you have questions, so forth, please let us know. But I will be out for a week, and I am, for the first time in many years, not going to take a computer with me. So I just want to make sure all of our members are aware. Been trying to give a lot of notice in our daily market reports. Also mentioned it yesterday in our weekly portfolio report. But I will not be around from this Friday through the following Friday. So daily market reports, all the shows. We'll probably have on Tuesday and Thursday of next week, I will likely have a recording, a previous recording on Stock Charts TV on a Trading Places Live episode. So that's on Tuesday and Thursday at 9 a.m. But here at Earnings Beats on Monday and Wednesday, we will not have anything for you for those 2 days while I'm out of the country. And then I'll get back the following week and everything will be back to normal again. So I just want to make sure everyone's aware. I want to pass that along. If you are new to Earnings Beats, or if you're new to our live stream, we've been streaming now on YouTube for the past couple of weeks. I want to welcome you. Appreciate you tuning in. We do this here at Earnings Beats on Mondays and Wednesdays from 9 to 9:30. If you want to catch my shows over at Stock Charts, if you go over to Stock Charts and you go to Stock Charts TV, Tuesdays and Thursdays, same time, 9 to 9:30 Eastern, you'll be able to catch my Trading Places live shows there. So really 4 days a week. If you like what you hear here, and you like my analysis, you like the way I approach the market, And listen, I call what I see. I don't care if it's bearish or bullish. Most people think I'm perma bull because the market goes up more than it goes down. So yeah, I tend to be more bullish. But there was nobody that was as bearish as I was to start 2022. I thought we had a chance for a cyclical bear market before it ever began. I pointed it out. I wrote about it. I talked about it. I issued report after report after report to Earnings Beats members saying, be careful. Patience was going to be the key in 2022. And now we're in 2023. And instead of patience, for me, it's all about perspective. Perspective. A lot of folks seeing bad news and they think, oh, market has to go down. Folks, it's priced in. We went down 28% on the S&P last year. We went down over 35% on the NASDAQ. How much do you want? We had a really significant sell-off. I'm not saying we can't go lower. I'm talking about perspective. Think about history. There have been very, very few instances where you go down 28% on the S&P 500 and then you keep going lower. 3 times since 1950. 3 times. So keep that in mind as we go through. We talk about the market. I'm seeing signals that suggest we're not going back down. First of all, and one of the big ones is sentiment has reset. That was the thing we needed the most back in 2022. Everybody was so bullish going into 2022. We had the most bullish equity-only put-call ratios by a mile that we had ever seen before. It wasn't sustainable. The advance we had in 2021 was not sustainable. We needed bearishness. We needed folks to get panicked, and we needed to reset sentiment. We've done all that. But now everybody's still panicked. Everybody still thinks we're going to go down. This move down has been smoke and mirrors. This last move down here on the S&P 500, it's been all gaps. The entire move to the downside on the QQQ, we had lost $20 on the QQQ, $22 in gap downs during this period. So before you get overly excited thinking, oh my gosh, everybody's selling, everybody's not selling. Market makers are opening prices lower. They're getting folks to sell in the early part of the day, pretty much like they did the second half of 2022. But there are buyers out there. This is different than January to May of 2022. Back then, we saw some gap downs, but we saw selling throughout the day. Selling all day long. Second half of 2022, that changed. Wall Street was accumulating, and on this pullback, it's been the same thing. Listen, if things change, I will let you know. But I'm not seeing anything different right now than what we saw in the second half of 2022, where we would get sell-offs orchestrated by market makers. We'd see the morning selling, I call it amateur hour, and then we would see accumulation throughout the day. And that's what we've been seeing lately. I wouldn't be surprised if the market were to take right back off here. I'd be much more surprised to see the market go back down to the October low than I would to see the S&P 500 go straight to 4,500. I think we got a better chance of the S&P going to 4,500 during the month of March and April than we do to go back down to 35 or 3,600. I mean, in my opinion, 90-10, I would give the odds. So I'm not saying it's 100-0, but I think the odds are much better. We have a chance going up based on everything I see in the market. Anyhow, if you do like what we do at Earnings Beats, I do want to mention, if you go back over here to Earnings Beats, we have a free Earnings Beats Digest newsletter. We'd love for you to subscribe. Name and email address, all it takes. No credit card. No, you can unsubscribe at any time. If you don't like it, feel free to unsubscribe. One major benefit of being part of our Earnings Beats Digest community is when we have a free event. We do a lot of educational events during the year. We open it up to all of our community, including our Earnings Beats Digest subscribers. When we have those free events, if you are on our EB Digest, we'll reach out to you, give you room instructions, and you can come in, no cost, no credit card, and follow along with some of our educational events that we do throughout the year. So a lot of perks, a lot of benefits, and no cost. I don't know why you wouldn't want to at least follow along. And like I said, if we don't appeal to you, you can unsubscribe, no questions asked. We'd love to have you. Also, for those of you that are watching this on YouTube, please click the like below and also subscribe. We plan on doing a lot more of these types of things on YouTube in the future. And if you want to be part of that, make sure you subscribe and follow along. All right. So looking at the major indices last week, obviously was not a good week. Historically, how many times have I told our members and all of our community, the 19th to the 25th of calendar months, historically, is when you want to be careful in the stock market. I'm talking every calendar month. So not just February, January, February, March, and so on. Historically, the 19th to the 25th is the worst period. And if you think about it, think about when options expire. Monthly options expire the third Friday of every month, which falls from the 15th to the 21st. So it's the time leading up to options expiration, and then it's the period just beyond options expiration. That's when the market has the tendency to drop. Why? Because new money comes into the market in the middle of the month, and that tends to drive the market higher. So we normally see the market heading up into options expiration Friday. And so when that happens, you get a lot of in-the-money calls. Traders that have bought calls make money as the market rises. And so you get net in-the-money call premium. And how does the market maker get rid of that? By directing prices lower. And market makers use their own capital. If you don't understand the role of market makers, you are one leg behind everybody else in the market. You need to understand their role. They'll take the other side of trades when there's an imbalance. They trade for their own accounts. They trade for institutional clients to get, there was an independent market maker, Knight Trading Group, many, many years ago. And I used to study the heck out of that company. But their business, what they did is acquire shares for their institutional clients at the best price possible, quote unquote, best price possible. What's the best price possible? Best price possible is when you're panicking and you're selling. That's when they're buying. Best price possible. Think second half of last year. All the gap downs and folks selling in the first half hour, 45 minutes, even an hour. Best price possible. That's when they buy, when everybody else is selling. Got to understand the market maker role in the market. Anyhow, you can see all of the major indices have moved back below the 20. Some have moved back below the 50. Keep in mind, some say, well, okay, here we go again to the downside. I don't think so. I really don't. The thing you have to realize about moving averages is that you can go up, above, and below during trendless periods in the market. I believe we're consolidating. I do not believe we are selling back off and heading back to October low. I could be wrong. I don't have a crystal ball. I don't have a guarantee. I don't know for sure. But I've studied the market for a long time. I spend a lot of my free time studying the stock market. There are some things that repeat themselves over the years, and you can start to see patterns. I would not be surprised to see sideways consolidation. Now, March, I can tell you, does tend to favor more value-oriented defensive areas of the market. Look at the Dow Jones hitting its key support right here. I wouldn't be surprised maybe to see the Dow Jones lead over the next few weeks. It led during October and November by a mile. And then since beginning of December, it's been flat. And look at the NASDAQ since December. January was a huge month for the NASDAQ. So we see rotation. Based on the way things are setting up, I wouldn't be surprised to see the Dow the best performer during the month of March among the major indices. I don't say for sure it's going to happen. I just think that it's very possible that we could see the Dow begin to pick back up again on a relative basis. The other thing I would not ignore on these charts, I've said it over and over and over again, the AD lines. Look at the small caps moving down to, it looks like it's been moving straight down for about 3 or 4 weeks, right? Look at the AD line going up, continuing to move up. How does that happen? It happens because we're gapping down and then we're seeing buying in the afternoons. That's how AD lines move higher. If you go back through cyclical and even especially secular bear markets, the AD lines don't come back up to new highs and just keep going higher and higher. Eventually, when we turn down, these AD lines take a big hit because you need selling, you need distribution. The AD lines are pointing up and they continue to point up, even with the market selling off the last few weeks. Looking at the sectors, materials were up on Friday. That was about the only group, really. We had a couple up fractionally, less than 0.1%, but materials really the only group that was up significantly, got back up to 81.19, just below both of its moving averages. We'll see if it can move back up above. The other four that I show you here were the four worst performing groups on Friday. It started with real estate, which was down 1.85%. Technology, 1.78%, discretionary, 1.57%, communication services, 1.39%. These last three are your aggressive sectors. We do want to be careful when they are selling off. I mean, when the market sells off, these tend to be the worst performers. So there's no really big surprise there. What I'm going to be watching, though, is during the rally, do these groups lead or do they take a backseat to more value-oriented groups? If so, then I don't think we're just going to take back off. I think we'll probably go through a period of consolidation because we normally don't get led by the Dow Jones. We don't normally get led by utilities or staples. And I'm going to show you some things about those sectors during the month of March here in just a minute. Normally, we like to see leadership from these aggressive areas: technology, discretionary, communication services. When the market is moving up to new highs and these groups are behind the move, that's very, very strong bullish action and usually quite sustainable. So that's one of the factors, one of the things we need to look at when the market makes its next move. Is it being led by these groups? Because January's advance absolutely was being led by these three groups. Look at these three just taking off in January. So yeah, we've seen some profit taking. Remember, these are the three groups where you get most of that in the money call premium. These are the groups where most people trade options: technology companies, discretionary, fast movers, internet, which is in communication services. These are the companies that can move really fast. And that's what options traders strive to do. They want to see their options move fast. So let's keep an eye on these three. 10-year Treasury yield. As far as economic reports go, this morning, we had the January durable goods come in minus 4.5%. That was the actual for January. Now, the estimate was minus 4.0%, so most of it probably already baked in, but it was slightly worse than expected. But if we strip out the transports, if you look at the durable goods ex transports, they actually rose during the month of January, 0.7%. The expectation was flat. So it just depends on, is the glass half full or the glass half empty? What are you looking at? Because if you include the transports, it was a bad January. If you'd strip them out, it was pretty good, better than expected. So as we look at the 10-year Treasury yield, we get the update here right now, 3.93%. We're down 2 basis points. This was the breakout above 390 I was talking about. Next move would be 4%. I do think there's a little bit of psychological something there. If we go through 4%, we want to watch that. 433 is ultimately the high. That's where we got back in October when the stock market was at its low. But we'll see what happens. I would expect that the market would struggle, especially growth areas, if we break above 4%. And I think that's where we could see, like we did back in October, money rotating more towards the Dow, more toward value-oriented stocks until we get the 10-year Treasury yield to roll over. And when we get a sustained move in the TNX to the downside, that's when I believe we are going to get a huge move up in the NASDAQ and in many of the growth-oriented areas. I think it's going to happen heading into the next quarter's earnings. I think as we get toward the end of March, if we haven't already begun a move to the upside, I think we're going to see one then. Not really a whole lot else. Later this morning, we do have January pending home sales coming out. December rose 2.5%. We're expecting January to rise another 1%. That'll be out again at 10 a.m. this morning. All right, S&P 500. So we did print. Look at the last couple of days. We were down intraday, but look at the rallies back into the closes. When I look back, I see maybe 3 days, one here. See these red filled candles, 1, 2, and then another big red filled candle here. Maybe this one we finished at the low. So there were maybe 4 rough days during this downtrend. But for the most part, even while we were moving lower, the market was rallying back. And that's why the AD lines continue to be strong and continue to move up. I mean, even with the move down in August, September, and October, we saw the AD line at least pause and start to move a little lower. Here, we haven't seen any of that yet. So we'll see what happens. But S&P 500, I'm still thinking potentially. Let me be really clear about this. I'm bullish. Market, I believe by the end of the year is going to be a lot higher than it is right now. But historically, and knowing the way the stock market trades, I do think that the market is most vulnerable now through the end of March. And I'm going to show you seasonally why that is in just a couple of minutes. But we do have to be a little bit careful. I do think we're going to see some rotation away from growth, and we've already seen some of that away from growth and into value. When we put our portfolios together, we put 10 equal weighted stocks in 3 different portfolios, and we hold them 90 days. We did that February 19th. And when we did them, I said, hey, I'm going growth. These portfolios are growth oriented, but we may start off weak. The first couple of weeks to even a month maybe could be a struggle. But then I see an explosion as we head into April and May. And so it wouldn't surprise me to see short-term movement to the downside. And I know, I probably shouldn't even bother reading YouTube comments, but every once in a while I'll read those. I'll go through, and because I'm looking for questions maybe I can answer on shows, and usually I just get garbage. But and when I say garbage, it's just people saying stuff with no backup, nothing of value to have a debate over. That's what I mean by garbage. But sometimes I'll get comments like, oh, you just said the market's going up. Now you're saying it's going down. No, listen to what I'm saying. The stock market is going higher. Stock market, in my opinion, is going higher in 2023. I think I'm pretty clear. The market is not going to go higher every day and every week, though. There are periods when the market historically pulls back. Listen, I'm a swing trader. I'm not a buy and holder. If I'm a buy and holder, I'm in and I'm holding and I'm not selling. If I'm a swing trader, why do I want to hold when the market gets up here in February and we have options expiring and we know historically that the market tends to pull back? Why do I want to hold stocks that I've made money on when I know we're heading into the month of March, which tends to favor defensive-oriented stocks? Hopefully, I'm clearing everything up for everyone. The market, in my opinion, goes higher in 2023. If we're going to go lower, if we're going to hit 3,800 even to test this December low, I believe this is the time it could happen. Will it happen? I don't know. I'm remaining long. And here's my philosophy in the market. Back at the beginning of 2022, I said the market was going lower. I was bearish, and bear market rules, in my opinion, applied, meaning that for the most part, you either want to be short or in cash. Once we hit bottom in June, called the bottom right there. Then at the end of September, when we got back down and tested it, I said, here's your second chance. Once I get bullish, I don't short anymore. Shorting is done. I will not short. Now, I might move some into cash when the market pulls back. If I am in the market, I could be in the spider or the QQQ, and we get to a point where I think we're going higher, I start moving out of it into more aggressive leveraged ETFs. I did that last week. As the market was moving down, I was telling members, I'm moving some of my money from the QQQ into the QLD in preparation for this morning and for another push to the upside. The market does very well at the beginning of March. Beginning of all months, money flows. I was in public accounting. I practiced as a CPA for 20 years. I audited companies. I was in charge of our firm's accounting and auditing committee. I understand the technicals. I understand the fundamentals. And I also understand history. When I was auditing back in the 1980s, 1990s, a lot of folks, that was when the 401ks came out, a lot of folks were putting money into their 401ks in their payroll checks, right? Coming out of their payroll checks. That money would be aggregated a lot of times at the end of the month or in the middle of the month, and it would be forwarded on to the plan sponsor, whether it be Fidelity, Vanguard, whoever. When they get the money, they don't look at the market and say, oh, well, it looks a little overbought here. I don't think John Doe or Jane Doe really want me to invest their money right now because the market's a little overpriced. They have a fiduciary responsibility to invest that money as soon as they get it, based on the directions that they've been given. Money flows, if you look at how the stock market performs, the 28th of one calendar month to the 6th, you have a spike in the market. Then you come down, profit taking from the 7th to the 10th. 11th to the 18th, you have another spike. Again, money coming in. Then 19th to 25th, options expire, profit taking, blah, blah, blah. That's the history of the market. Now, it doesn't happen that way every month, but that historically, I can show you numbers. It's mind-boggling. As a trader, you need to know these things. So last week, options expired the week prior. It was the week after options expire. And guess what? It was from the 19th to the 25th. Was I surprised to see the market pull back? No. Why? Because I study history. You have to understand a lot of different things. The stock market's huge. There's so many factors that go in. Just saying, oh, it's going to go up or go down today is pointless. You might as well, toss a coin. Although, knowing history the way I do, I can tell you which days the coin is weighted toward heads. But anyway, so that's where we are right now. We're back at the 50-day moving average. I think we could roll back to the upside. I think we're going through a period of consolidation. I do think we're starting higher highs and higher lows. So what I've said is potentially I could see maybe 3,800. That would be my downside. I'm not saying we're going to get there. I'm saying that is a downside. But make no mistake about it, I'm not shorting. If we go to 3,800, I'll lose money. I can guarantee you, because I'm invested on the long side. I'm going to stay there. And I'm okay with that. NDX, basically same thing. I mean, move up, back down below the 20-day, still above the 50 quite a bit here. I don't know, maybe 11,700, 11,600. Maybe if things really got a little rough, maybe we go back down there a couple, 2-3% more. I don't know. I wouldn't expect a whole lot more than that. Again, I believe by April, I believe we're going to break back out to new highs. And I guess time will prove me right or wrong. Okay, I wanted to show you, I was doing some RRGs last week. I just want to show you a couple of these real quick. Here was a spider, and these are all the sectors going around. This is a weekly chart, and you can see moving from improving into leading is the XLC. It's the only sector right now that's in leading. Now, you do have technology, so if I just hit the technology down here, you can see it highlight. We're about to go into leading with technology. If you look at consumer discretionary, it's made a huge move from lagging into improving, and it too is moving toward leading. You do have to be a little cautious because a lot of times you will see areas move up and then roll right back over on the left side of the chart. So you go from improving right back into lagging. Same thing on the other side. Sometimes you can see leading and then you go back into weakening and then right back to leading again. But right now, if you look at the groups, on a relative basis, relative to the S&P, consumer staples, healthcare, financials, industrials, materials, and energy are all moving down, although energy starting to pick a little bit back up on the momentum. The vertical scale is momentum. Horizontal is relative strength. So energy was a huge leader when it was over here 5 weeks ago. Relative strength was off the charts almost. So that relative strength has been coming back down, but now we're starting to see momentum pick back up. So is energy starting to turn back up again? That's a question. Maybe. Energy could begin to start to show leadership again, based on what I'm seeing here. Not really seeing that in any of these other groups. Utilities, this is a perfect example of going into improving and utilities rotating right back into lagging. So that's kind of the picture right now. The aggressive groups have been improving and continue to improve. And that's mostly thanks to the month of January, where we saw that huge move. So let's talk a little bit. It's almost 9:30. Market's going to open here in a minute, but I want to show you the utilities. I want to show you the consumer staples, and then we'll wrap this thing up. So first here on the utilities, just the last 5 years, the month of March, look at utilities relative to the S&P 500. They've outperformed every year in the last 5 years, 100% of the time, and they've averaged outperforming by 4.1 percentage points over the last 5 years. And if you look at any other month, I mean, May's 1.7, August 0.8, September 1.1, December 2, but 4.1. Clearly, March has been the best month for utilities. Now, that's just the last 5 years. Now I'm going to go back 11 years, which takes us back to 2013, which is when the secular bull market really kicked into gear. In 2013, that's when we cleared the 2000 and 2007 high on the S&P 500. And since then, we've been going up with some cyclical bear markets along the way. Last 11 years, XLU relative to the S&P 500, it's outperformed 90% of Marches by an average of 3 percentage points. So this isn't just the last 5 years. Now we're going back throughout the entire secular bull market. Secular bull market, when utilities and other defensive areas typically don't do well. March has been a shining light for utilities. So if I was investing in sectors, and if I was very aggressive, I might take some out and maybe just hedge a little bit with some of these more defensive areas during the month of March, because they do tend to have a history of performing better. And the reason for it, in my opinion, is pretty simple. The first 2 months of a quarter are when earnings are coming out. Market anticipates earnings. Money is rotating into the growth, the really aggressive areas. And then after earnings season comes to an end, folks take profits, and the money doesn't leave the market in a bull market. It simply rotates. And so March tends to be a period when utility gets a little bit of love. If you look, March, June, which is just basically flat, September basically flat, and then December, the fourth or the third calendar month of each quarter after earnings is over, is when utilities tends to do pretty well. If you go and you look at the first month, January, April, July, and October, it's relatively flat. If you go to the second month, minus 1.5 in February, minus 0.8 in May, flat in August, and minus 3% in November, you'll see the second month, utilities tend to do very poorly. Now let's look at consumer staples relative to consumer discretionary. Over the last 5 years, look at March. Well, we haven't had March this year, so it's of the last 4 years. So 3 out of 4 staples have outperformed discretionary, and by an average of 2.7%. And if you looked across here, the best month is December. What is December? It's the last month of a quarter. Again, money rotates more toward defense in the last month of a quarter. So here we are, 2 days from March, getting ready to move into March. What do we want to do? Do we want to go all in on utilities and staples? No, I wouldn't say that. But if you're trying to be somewhat cautious, it kind of makes sense maybe to park a little bit of money in utilities and staples. Maybe be a little bit more diversified for the month of March, a little less aggressive. Hey, if the aggressive stocks take off, you're still going to do well. But it hedges you a little bit in case this rotation maybe takes the NASDAQ down a little bit further, maybe even the S&P goes down. But some of these other areas like staples and like utilities, maybe healthcare, real estate, those areas might get a little bit of a boost as money rotates away from some of the aggressive areas. So anyhow, that is basically what I wanted to go over. Let's take a quick look at the market for everybody. See if we did get off to the good start. It looked like we were going to get off to, yeah, NASDAQ up 1%. So that's pretty good. Dow up 3/5 or 6/10 of 1%. S&P up 3/4 of 1%. VIX down 1.5%, back down to 21. If we do start to move higher, I'm going to be watching the VIX. Will the VIX stay up? If the market moves up and the VIX goes up with it, that would be a warning sign. And it happens sometimes. So that's one thing to watch out for. But if the market moves up and we start rebounding and the VIX, continues to move back down into the teens, that is a really good sign. It doesn't mean the market's going to explode to the upside, but I think that would start to argue for this sideways consolidation period until we get to the next big up move, which I think is coming. Again, all of this, in my opinion, you do what you want with it. Again, thanks to everybody for tuning in for all of our shows, but especially those of you now who are finding us on YouTube through our stream. We certainly appreciate you coming in. Mark your calendars every day, 9 to 9:30, Monday and Wednesday. It'll be right here at Earnings Beats. And on Tuesday, Monday and Wednesday, Earnings Beats. Tuesday and Thursday is over at Stock Charts. You can reach me and see that show on Stock Charts TV at 9 a.m. All the shows 9 to 9:30. All right, listen, everybody have a great day. Appreciate you tuning in, and I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. Have a great day, everybody. Happy trading.